Good morning, everybody. Good morning. Good morning. Good morning. What's going on, everybody?
Hey, how you doing?
All right, pretty good. Pretty good. Good to have you. Good to have you. Good to have you.
Yeah, no problem.
What's up, man? What's going on? Good morning. Good morning. My man with the Christmas tree in the background. How's it going? Good morning, y'all. Good morning. Good morning. Morning. We're going to get started in a couple minutes. We'll allow maybe about another 60 seconds for folks to jump on. For the folks that's new with me today, if you don't mind coming off mute, I like this to be interactive. So if you don't mind coming off mute, let me know your name, where you are tuning in from, something you want to get out of today's session. We're going to be on here about 60 minutes. And so if we'll have time for Q&A. I did want to cover something. If one of my other clients is going to jump on, we'll see if he jumps on. But I'll get into that in a minute. But if you all will come on, introduce yourself, come off mute, your name, company name, what you do, what you look forward to hearing today. If you haven't gone yet, it's your turn.
Well, my name is Ryan. I've been here before. I've been coming on these webinars for months, so I'll let the new guys go.
Go ahead, man, because you never know when there's an opportunity where somebody may need your services. Yeah, company.
Yeah, so my name is Ryan. I'm a licensed general contractor in Washington, D.C. and in Pennsylvania on residential and commercial. I mainly focus on residential, but the last few months of running across you, I've been focusing on commercial. And I did take your advice, and I did get a construction management certificate from you had a recommendation for that, and a quick course in Florida, so I just added that to my Rolodex of certificates and degrees. So pretty much I'm just looking for more information how I can elevate on the commercial side. And,
recording in progress.
Picking up contracts, even working with larger GCs than me and coming in as a sub.
Yeah. Okay.
So
yeah, for sure, man. You need to get in our mentorship program, bro, because I got a year's worth of content dealing with just that. Like, we've been talking about that all year long. I know some people have time constraints. I'm actually thinking about shifting the time of this session going into 2025 to make it a little bit more flexible for other people. But how many know sometimes you do business the way you want to do business? So for me this year, 2024, I had to kind of do it during this time slot because I had so many things going on. But as I shift my focus to do more mentoring, more coaching, more business consulting, I'm going to try to shift my schedule around to make this more flexible for those that are out there grinding all day. Like my son, he out there working now. For those that's out there grinding all day, and you have more time maybe in the afternoons, the evenings to get more education, more implementation, more transformation. What's up, Ed? Edward, what's going on, bro? Your name, company name, what you doing?
I'm good, family. How you doing today?
Great, bro.
Good, man. Good to see y'all again.
All right, go ahead. State your name, company name, and what kind of work you're doing.
I'm Edward Bennett, Vertical Rise Construction Group. I'm a general contractor. We do a lot of residential. This year has been our probably biggest commercial year though since we started back in 2011. My dad was a general contractor, and I just kind of picked it up from him. He never got licensed. I got my license in 2011, and started out as a hobby with working with my rental properties, and the neighbors would see my work and would want me to do work for them, and that's kind of how it kind of took off a little bit for me.
Awesome. All right, we'll take one more and we'll go ahead and get started. Somebody else can come off mute, introduce yourself, name, company name. You just went on back on mute. Go ahead. There you go.
I'm mute now.
Yeah, you off mute
Yeah,
now.
my name is Malonza. Um, I'm a well, not well, general contractor. I got my license and um, my business name is Mel Handyman Service. So I'm
Okay.
looking forward and learning new things and stuff. I do painting and shop.
Okay.
You know,
Cool.
I can. You
Awesome. Awesome.
know, yeah.
Well, hey, welcome to the mentorship. Listen, y'all, I don't want to delay the time. We got a lot to cover. What's up, Nehemiah, Malachi? I got an iPhone user. Oh, maybe that was Ryan. Okay, and then what's up, Glenn? So, baby, if you can mute everybody else. Glenn, I know you had some Q&A we'll do at the end. So Glenn had a question. He's one of our elite mentorship clients, and he had a question in regards to having some 1099 staff that is converting over to W-2 employees, and he wasn't sure how to maybe pay them according to their normal wages, knowing that he's incurring some benefit charges and some other taxes and all of that. So I want to cover that today as well, but I want to do that at the end of the session. So if you all have time to hang out with us, we'll do that after the presentation. Now today, I'm covering those areas in the business that oftentimes most of us don't have experience with. Most of us, if I be frank, if I be honest, most of us don't have accounting experience. Most of us do not have an accounting background. Matter of fact, when I went to college at the University of Florida, now I'm dating myself, way back in 1994, Ed, I was there and I was playing around, be honest, tell you the truth. I was playing around in school, wasn't taking it seriously, and I actually took accounting. The first month I dropped it because it was so hard, right? The next time I had to take it because it was a prereq to get into my college at the time, architecture, and I was like, man, I got to take this class. The next time I took it, I end up basically not doing well, and I end up taking this class, Intro to Accounting, 3 times, and I said, man, if I ever never have to see accounting ever in my life, I would be so happy. I don't know about anybody else if you had an experience like that, but some of you may have not had an experience like that, but I said I never wanted to do accounting. And so let me tell you this real quick story, then I get into my presentation. So lo and behold, 2008 comes around. We have been in business legally about 4 years, actually doing work about 2 years. We had actually she was a full-time office manager at the time. She was handling things in the office administratively. She was the only staff that we really had other than me and my business partner. And she was also doing our bookkeeping. So the downturn happened. Anybody remember the downturn, 2008, 2009, when the economy just tanked and we actually slowed down, didn't have a lot of work, and we got to the point we had to lay her off. So now I have no one to do my bookkeeping. She had been doing my bookkeeping from the beginning. Like ever since we actually started a software internally and started keeping track of our bookkeeping, all of a sudden the lady that I leaned on was gone. I said, man, what I'm going to do? I have no idea what to do. And so I said, well, let me see if I can kind of learn some of this stuff. And so at the time we were using a software called Sage 100, or I forget the old name, but it's called Sage 100 now. And so we was Master Builder. That was the name back then. But we started using this software. She set it up. She got everything going. I said, it can't be that hard. I'm halfway smart. I said, let me try. What's up, Resna? Resdor, I said, let me at least try.
Hi, Michael.
Hey, what's going on? I said, let me at least try to get in this software to see what I can do. Then all of a sudden, I realized there's some stuff in here. I have no clue what I'm doing. And I don't want to mess anything up. So I called my CPA. CPA said, Michael, I'll come over and I'll show you and I'll help you. Listen, y'all, that's the benefit of having a good CPA, because all CPAs are not created equal. Come on, class. Y'all know I'm going to preach to you because I'm a minister also, right? Listen, I'm going to preach to you today, so you're going to get some hope, some motivation, all inspiration and transformation all in one. Listen, all CPAs are not created equal, because some of them, they'll do your bookkeeping, some of them do your taxes, but they may not do it right. And so I had to lay off my bookkeeper, and then I had to learn the software myself. And then all of a sudden, my CPA comes over and helped me learn more about accounting processes. And it was from there, over the next 2 years, that I was doing all of our bookkeeping myself. It was from that point that all of a sudden my eyes were open to realize everything could be managed and recognized. My awareness could increase of what was going on my projects if I knew the numbers. Because you all heard this before, numbers don't lie. How many of you all heard that before? Yes, numbers don't lie. Right? Raise your hand if you heard that before. Numbers don't lie. The numbers don't lie. And I preached this on Sunday. A lot of us are not looking at our numbers. A lot of us have no clue really what's happening. And I want to show you today how construction accounting is really different, but it will help you. It will be a tool that will help you to grow your business. Anybody up for that? All right, so I'm gonna do some kind of like low-level introduction. I'm not gonna go deep today. I can't, because I don't want to be too heavy. We're going into the holiday season. But if you want more, you say, Michael, give me more of that, and I'll make sure we set up a summit so you can come and learn more about construction accounting. Because I'm telling you, watch this, not only should you be the CEO of your company, but even if you never decide to wear the hat, you should be able to say, if I got to put my CFO hat on, I can. If I need to put on my CFO hat, Chief Financial Officer hat, I can. And so I want to show you all some things today, just kind of introduce you to some concepts and show you why it's really, really important that you know your numbers. Everybody shout, know your numbers. Go ahead. I know you're on mute, but say it anyway. Say, know your numbers. Come on, y'all.
Know your numbers.
Yeah, that's what I'm talking about, Rest Door. Know your numbers. So, all right. So let's get into this today. We're talking about construction accounting. And so just a reminder, you should know your numbers without relying on the amount in your bank account. Let me say that one more time because somebody missed it. You should know your numbers without relying on the amount in your bank account. How many of you all guilty of that? How many of you be honest? I track how much money I have by what's in my bank account. Come on, some of you all, you got your ski mask on. That's what I call them when I can't see your face, right? Some of y'all got the ski mask on. You got your pretty photos up there. I know it. Somebody ought to come off mute and say, yep, Mike, that's me. I just see what's in the account, and whatever's in the account, that's what I go by. Okay, so let me help you understand that is false information. False information. How many of you all have a CPA? CPA. Who don't have a CPA? Okay, I think one person. Okay, so listen, you as you grow your business, and so you may be kind of part-time or doing it kind of like a hobby right now, but as you grow, you want to make sure you have a CPA. You know, all business consultants teach all business owners to have a lawyer, an attorney, a CPA, and a banker, right? You need all of those in your toolkit, and you need to have a relationship, right? A relationship. I'm not just talking about somebody you hire, but a relationship with one of those three. And so when we're talking about, what's up, Corey? What's up, Melissa? So when we're talking about having a CPA, that CPA should be helping you get to where you need to go. So if they're just taking information, taking your money, and just spitting out a report for you, and they don't take the time to call you, they don't take the time to meet with you to help you understand where you're going, that's the wrong CPA. All right? Here's another way you know you have the wrong CPA. Are y'all with me? Say yes. Come on, drop a 1 in the chat if you're with me. All right, we got to get some action going around here. All right? Because this next 45 minutes is going to go by real fast. All right, drop a 1 in the chat if you're with me. Okay, so this is how you know you have the wrong CPA and you have a construction company. If they allow you to remain on cash accounting. I'm going to say that one more time. This is how you know you have the wrong CPA as a construction contractor and they allow you to remain on cash accounting. I'm going to explain the difference a little bit later. Okay, how many of you know whether you're on cash accounting or accrual accounting? Anybody know? Who knows? Anybody? Okay, Ryan, you say you know. Anybody else? Who don't know? Okay. Ed said, I don't know. Anybody else? Okay, my man said, I don't know. Anybody else don't know? Glenn, you can drop it in the chat. Are you on cash or accrual? Nehemiah, you could drop it in the chat if you all can't come off mute. Are you on cash? Okay, Nehemiah's on cash. All right. Glenn, I'm waiting on you, buddy. Are you on cash or accrual? Corey, thank you, Corey. All right, somebody teaching you right, Corey. Corey's on accrual. Anybody else? All right, so I'm going to say this one last time because this is vitally important. If your CPA has not consulted you and say that you should be on accrual accounting, that is the wrong CPA. Okay, and I'm going to explain some of that a little bit later. All right, I'm going to explain some of that a little bit later. So let's talk about some definitions. I'm not going to go through all of this because this is somewhat of an introduction, but I want to talk about like some key highlights for construction accounting that's really, really important. I really didn't anticipate all y'all showing up, to be honest, because when you start talking about accounting, people are like, man, I don't want to hear about that. Just tell me how to get to the bag. Tell me how to make them $1 million contracts, Mike. Like, that's all I want to know. And I'm like, well, I can tell you, but guess what? You'll lose it if you don't know how to do accounting. Anyway, definitions. We're going to talk about GAAP, debit, credit. Some of us know this. If you went to school for it like me, you'll know some of these terms. The difference between accrual and cash, we're going to talk about that. AJE. Anybody know what an AJE is already? AJE. Anybody know what AJ? Okay, nobody. Okay, I'm going to talk about that. Ledger codes, chart of accounts. We're going to go through some of these. I'm not going to cover everything, all right, because this was a template out of the summit, which is like a half-day summit in person where we do a workshop to help you through all of this, but I'm just going to present some of this to you, okay? So let's talk about what is GAAP. GAAP is generally accepted accounting principles. So every CPA, they're going to be standardizing the way they do things by GAAP, a set of accounting rules, standards, and procedures that companies must follow when preparing financial statements, all right? Let's talk about debit and credit. Most of us has heard this term before. It's an accounting entry that increases assets and expenses or decreases liabilities and equity. That's a debit. So if I want to debit a certain account, if it's an asset or an expense, I'm increasing that account. If it's a liability or equity, I'm decreasing that account. If I debit it, if I credit it, it's an accounting entry that increases liabilities and equity or decreases assets and expenses. So for example, if I want to say, hey, I want to credit the amount on my house, I want to apply a $10,000 credit on the amount of my house because it's an asset, I'm decreasing it if I do a credit. If I do a debit, are you with me? I'm increasing it. So the terminology can be very confusing, but if you take a note, take a screenshot of this, it'll help you remember. And I have a chart I'm going to show you a little bit later that would kind of help you always have a go-to so you can say, hey, if I'm debiting something, am I going up or down? Am I increasing it or decreasing? If I credit something, am I increasing or decreasing it? Because it depends on the type of accounting entry. All right, so that can be really, really confusing, but I'm going to give you a little cheat sheet, okay? And for those that are in the mentorship program, not only this recording, but also these slides will be in the portal, okay? All right, so now let's talk about what I was talking about earlier, the difference between accrual and cash accounting. The difference between accrual and cash. Accrual recognizes revenue and expenses when they are earned or incurred, not when cash is received or paid. If y'all got that, drop a 1 in the chat, because this is really, 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 really important. For all my construction contractors, accrual accounting, which you should be doing, recognizes revenue and expenses when they are incurred or earned, not when cash is received or paid. All right, drop a 1 if you with me on that. So what does that mean? Anybody understand what that means? Raise your hand. Who got that? I know my man Corey should have it because he's on accrual. Anybody don't understand what that means? Raise your hand, and I'll break it down a little bit further. Come on, y'all, come off me, Mike. Okay, my man say, let me get your name again. Oh, Malonzo. My man Malonzo say, Mike, I don't get that. Break it down again. Okay, so let me break it down. So, most of you all are on cash accounting, which means when you receive money for a job, you identify that transaction when you make the deposit in your bank account, right? So you identify, hey, I received the payment. It could have been a check, could have been a credit card payment. When that transaction goes through and deposit into your bank account, that's when you acknowledge that income. Only then do you acknowledge it. If you haven't received payment yet, you haven't received income. That makes sense? So cash accounting says when I receive the cash, that's when I acknowledge it. That's when I've earned it, when I've received it. Same thing with the expenses. When I've actually paid money out to a vendor, right? Or I went to Home Depot and I spent money. I incurred that cost. That's when it happened. All right? Now, accrual accounting is different. Accrual says we recognize revenue and expenses when they occurred, not when cash is moved. So guess what? Even if cash doesn't move, I'm still recognizing it. What does that mean? So let me give you an example. How many of you send an invoice to a client and have to wait to get paid? Okay. Anybody else? You send an invoice to a client, you have to wait. Well, I don't care how long. You have to wait to get paid. 1 day, 2 days, 1 week, 1 month, 3 months, 4 months. Okay, so the difference is accrual accounting says I'm going to send the invoice and I recognize because the work has been earned. I recognize that as income even though I don't have the cash yet. Does that make sense? Yes, yes? All right, I need to hear back from some of y'all with the ski mask on. I need to hear back from you because I don't know if you following me or not. Okay, so let's say for instance, right, I have a credit account with a supply shop, a lumber shop. They give me a credit account. I go down there, I purchase $1,000 worth of lumber. I haven't paid any cash for it yet, but they're going to send me an invoice, so I owe them. So I actually will say, hey, I accrued this invoice or this expense now at this date, the date of the invoice. So I actually track that in my books that way, even though I haven't paid them. I'm already says I spent $1,000 without releasing the cash yet. Does that make sense? So let me tell you why this is. Anybody want to know? Okay, y'all got to come off mute because y'all just too quiet. Anybody want to know why this is important? Anybody want to know why this is important? Say yes.
Yes, sir. Paper trail.
Well, not only paper trail, Malachi, but here's what's most important. Because if you're living by what's in your bank account, you don't know what you have already incurred as income or as an expense because you're looking at cash. Let me say that again. Because you have not recognized what you have incurred. So what do you mean, Michael? That means if I have credit accounts and I don't recognize I actually incurred $5,000 worth of expenses, and I'm looking at my bank account and it says I have $7,000 in there, but I don't have any income coming in. Guess what? I really don't have $7,000 in there. I really have $2,000. Because I've spent money, I just haven't depleted the cash yet. So what happened is, Nehemiah, we walking around thinking we got $7,000 of cash in the bank, and we really don't. We really owe somebody else $5,000. So what accrual does, it allows you to true up your financials, so you stop living by what's in your bank account and you start living by a financial statement. It's so good. I promise you, this will help you so much. Because guess what happens? Ryan, this is what happens. Bro, when you dealing with maybe, some small jobs, 10,000, 20,000, 30,000, you can kind of maneuver it, figure it out. But when you start dealing with $1 million contracts and you done spend $500,000 and you don't realize that you really spent it and you looking at the cash in your bank account,
that threshold low.
Right. and you get in some real trouble real fast because you're not looking at your financials. Does that make sense? Or vice versa, You could have invoices out there that you know that are out there that hadn't been paid, and you're not recognizing the income that you should recognize. Let me tell you how else that this impacts you. If you go to the bank and you're looking to get a loan, let's say for an example, you did, $100,000 worth of work, you invoiced it in 2024, but you only got paid for $30,000 of it. You did $100,000 worth of work, you invoiced it all, but you only got paid 30. We go into the year 2025, you only received 30,000 on 100. Guess what? When you take your financial statement to the bank, it's only going to say your revenue is 30,000. Well, you did $100,000 worth of work, but you never recognized it. That's another reason why you need to be on accrual. So you actually recognize the revenue you have actually earned, not necessarily the cash that's in your bank account. Okay, now here's the great thing, and I want you all to get this because it's not in the slide. You can be on accrual accounting for your bookkeeping and cash accounting for your taxes. I see Ryan shaking his head. Who's that? Corey? Corey shaking his head. All right. Yeah, I'm getting y'all mixed up. All right. I see Corey shaking his head. Right. You can be on accrual accounting for your bookkeeping and cash accounting for your taxes. Now, your CPA has to know that. Otherwise, your CPA, or if you file with the IRS that, hey, I'm on accrual, then they're going to tax you accrual. Why would that be bad? Anybody want to guess why that would be bad? Corey, you ought to know the answer to this already. Why would that be bad?
Money that you haven't received, so you'll be taxed on money you don't actually have in your bank account. Is that correct?
Yes, sir. Right. We don't want to pay taxes on money we haven't received yet. That's crazy. Right? So that's why you want to be taxed on the cash. That means I've received this cash, I'll be taxed on this cash I received. So that's why you want to make sure your CPA recognize that difference. All right? Okay. So one is it's a reporting mechanism that helps you true up really where you are so you can manage your job, so you can manage your financials. The other is another mechanism so you can manage taxes. All right. Okay. Any questions? Let's do questions real quick. Any questions on that? Any questions on that? All right. So let's talk about the next definition of adjusting journal entry and a journal entry. So adjusted journal entry is made at the end of an accounting period to update accounts for accruals, deferrals, or estimates. A journal entry is a formal record of financial transactions in the accounting system, typically recording the debit and the credit. Babe, go ahead and mute Malachi. So,
okay. Thank you.
All right. So let me explain the difference or what it is. In your bookkeeping software, whatever software that is, QuickBooks, Sage, whatever, there's something called a journal entry. Normally, when all your transactions come through, normally the software will automate a journal entry. Back in the old days, we used to manually have to put in a debit and a credit. Anytime you do a journal entry, there has to be a matching debit and a credit. So most times, if you debit one account, you have to credit another. Always know that. And the amounts have to equal each other. Anytime you debit one account, you got to credit somewhere else. That's a true journal entry. So for an example, and I'm going to show you an example of this, let's say I paid a vendor. I paid Home Depot. I had cash coming out of my account, but I had an expense for that material. So I'm going to credit my cash account and debit my expense account. All right, so that's what a journal entry is. Again, your bookkeeping software is going to automate that journal entry so you don't have to do it. However, there's something called an adjusting journal entry. So from time to time, I'll give you an example. From time to time, you may have to move things from one account to another for a specific reason. And you have to do what's called an adjusting journal entry. Or your CPA may do this for you, and you need to know what they're doing. Or your CPA may or should do this, and you need to know what they're doing. And I'll give you an example. let's say, for instance, you move to your accrual accounting and you recognize that you have overbilled on a job. That means you haven't really earned what you're billing them, okay? And I'm gonna show you a little bit later. When you overbill a job, let's say you invoice a job for $100,000. You got a $500,000 job, you invoice them for 100, but you only did $50,000 worth of work. You have overbilled them because really the work you put in place is only worth 50,000. Now this is called like advanced accounting, what I'm telling you now, right? Somebody's trying to get in, okay. And so you've overbilled them, right? $500,000 job, you billed the client $100,000 on the invoice, you really only put in place 50,000. Are y'all with me? Yes, yes? Drop a 1 in the chat if you with me. Okay? You overbilled them. What does underbill look like? Underbilling means you spent $50,000, but you only sent them a $25,000 invoice. Underbill. Okay? So overbilling and underbilling actually impact your financials. They actually impact your financials, right? So if I overbill, that means I'm overstating what I should be recognizing. Are y'all with me? So we talked about accrual accounting. We're going to recognize things as they come in, but now we're adding another layer. That means I've invoiced more than I should have. Most people do that. How many contractors ask for a deposit before they get started? What's up, Marlon? How many contractors ask for a deposit before they get started? You just overbilled, right? Because your cost is zero, but you overbilled for whatever you have in. So most times we stay overbilled, most of us, not all the time, we stay overbilled through the course of a project. Now, how can that impact your finances? How can that impact your financials? Anybody want to guess? Anybody want to guess? Nobody. Corey, you want to guess for me? Come on, Corey. Anybody want to guess? How can that impact your financials if you stay overbilled? Anybody want to guess? Nobody? All right. This impacts your financials because you're overstated. So what we would do at the end of the year, we would do what's called a adjusting journal entry to reduce your revenue. To reduce your revenue. Why? Because you're overstating it. You didn't actually earn it. So let's say you had to go to court, there was a big lawsuit, and you know you didn't earn that money, right? Or maybe you had to get some of that money back, or something happened where it's at risk. You didn't earn it. So what happens is it really reduces the true amount of your revenue. So a good CPA, good bookkeeper will know at the end of the year, we're going to look at all your projects. All right, we're going to take a list of all your projects. We're going to see, are you overbilled or are you underbilled for all your projects? Then we're going to add it all up, and then we're going to do adjusting journal entry against your financials. Right? Any questions? Any questions? Okay, I know that was heavy. So balance sheet is a financial statement that shows a company's assets, liabilities, and equity at a specific point in time. It shows your assets, liabilities, and equity. All right, and then we have the income statement, or you'll hear a lot of times the P&L. Sometimes it sounds like letter P, letter N, letter L, but it's not. It's P and L. Profit and loss statement is a statement that shows your revenues, expenses, and profits. Now, if you have a CPA, you should be getting both of these every year, a balance sheet and a P&L. And then really you also should get a statement of cash flows. All right. So we talked about underbilling. Overbilling is billing the client more than the cost of the work completed. Underbilling is billing the client less of the cost of work completed. So how does overbilling impact cash? All right. Come on, y'all. Somebody come off mute. How does it impact cash? If you overbill a client, how does that impact cash?
You have more cash flow.
There you go. That's why more contractors try to overbill, because they're trying to get more cash in, right? However, what happens? We're now overstating the amount we've earned. That would actually now, when we go back and understand, how does that impact revenue? We actually have less revenue because we overstated it. Now, this is the thing. If you don't have a good CPA, guess what's going to happen? They're not going to offset what you've overstated because they have to get that information for you. And that means, stay with me, class, that means if you're not tracking each project, you're not able to see whether that project is underbilled or overbilled. Okay. Now, Marlon, for you all, you may not need to do it per project like our contractors that's on the line, but you may want to do it per client. So Marlon or Isabel, whoever that is on the line, you all may want to track your itemized costs, not necessarily by project, but maybe by client. So, because you may bill your clients differently. All right. So I want you to start thinking about that. And Marlon, you all should think about making sure you're on the accrual as well, because the more invoicing you start doing, I know you all do a lot of singular transactions and do a lot of B2C, but as you do more B2B, business to business, you want to make sure that you start looking at, hey, maybe it's time to switch to accrual because we are actually invoicing more clients, and it may take a while to get paid. Now, if you're getting paid cash up front for everything, stay on cash. All right. But anytime you start invoicing or having a lot of credits on your expenses, you want to start looking at accrual. Okay, because now you can start truing up what your actual financial health looks like. All right, let me give you another terminology. What time is it? Let me give you another terminology. Cost of goods sold. Now this is going to show up on your P&L, your income statement. Cost of goods sold. It's the direct cost of producing goods sold, including materials and labor. Now, I brought this up because a lot of people are not familiar of this term. We use COGS, C-O-G-S, cost of goods sold. Basically, it's all the expenses that are associated with what you do specifically. So for a contractor, it's not all your overhead. Overhead is separate. Overhead is like things like your office, your internet, maybe the power bill at your office, all those general things that you need, office supplies, right? Your cost of goods sold, is specific to things to get that project completed. So the materials and the labor that's going into that job, the equipment, any equipment rentals, even your staff that is specifically working on that job. So your superintendent, they're part of your COGS. So I had one client, they had a CPA that wasn't that good, and they were putting all their payroll dollars in overhead instead of COGS. I'm like, no, we need to separate that. Somebody may ask, well, why is that important? That's important because a bank is going to look at your financials and wonder why your payroll is so high, when it should be allocated to cost of goods sold. All right, so that's a whole advanced level of accounting, so I won't deal with that today. All right, but I want you to understand cost of goods sold is specifically related to what it takes, the materials and labor it takes to get the project completed. All right, here's the last one, last definition. So, anybody has a CPA that provide reviewed or audited financials for you? Anybody on the call? Anybody? Yes, yes, or no? Drop a 1 in the chat if you are getting reviewed or audited financials. All right, drop a 2 in the okay, who said yes?
That's me, that's Edward.
Okay, Edward. Okay, which one are you getting? You know?
The CPA I use, she does like a audit, like coming close to the end of the year around October time frame.
Okay, so I can tell by how much you spend. Which one? How much you spending for it? How much you spend if you don't mind sharing?
No, I don't mind at all. It's like $1,100.
Okay, most likely that's a reviewed a reviewed financial statement. So most audits, even if you're small, most audits start at no less than $4,000 or $5,000. So the difference between a reviewed statement and an audited statement is when a CPA comes to do an audit, they're literally asking for not only all of your accounts, bank accounts, credit accounts, but they want to see the paperwork. They want to see the receipts. They want to see everything. And they're going to sit in your office for a couple of days to even a week to go through it and see if they can find receipts and everything that match every transaction. That's audited. Audit is a very, very detailed where they're looking at everything. Most people, because of the cost, are getting reviewed. Now, some of us are not getting anything. We're just having a CPA do our taxes at the end of the year. That's it. Sometimes they'll produce a financial statement, or what they'll do, they'll issue what's in our bookkeeping system. That's still not reviewed. When you get a reviewed financial statement, they're going to send a letter that could go to a bank or anyone else that says they have fully reviewed your documents and have assured that everything has been done according to GAAP. We talked about that definition at the beginning of the session. So if you don't have a letter like that that accompanies your financials, you most likely don't have a reviewed statement. Now, I'm going to say this last piece, and we're going to maybe touch on one or two more things and go into Q&A. If you are ever doing government contracting, you're most likely going to need a bond, whether it's local government, state government, federal government. Most likely you're going to need a bond. Some private owners will require you to have a bond. If you ever have to get a bond, you're going to need to have reviewed financials. Now, I need you to know the difference, because there may be requests for proposals that ask for financials. If they don't specifically ask for audited, give them reviewed. And I'm telling you, that's a lot of money, so you need to know the difference. I don't want you going out and getting an audited financial statement if you don't have to. Most people will never have to get an audited financial statement. Most of the projects I've been around that ask for audited is like highways, like FDOT, or wherever your state, LDOT, Georgia, GDOT. Like usually it's DOT that's asking for audited. Most times they don't ask for audited, but they will ask for review, especially every bonding company. They're not going to just take your internal financial statements. They want something that has been an inter-year reviewed financial statement. All right, y'all with me? Yes, yes? All right. Let me go into this last piece, and then I want to get to Glenn's little situation, because I think it would help everybody. I have way more, so when you all go on the portal and see the slides, it's like I didn't even touch half of them. All right, I just don't have time, and some of this kind of heavy. We need to do this in like more of a workshop style, so I don't put you all to sleep. All right, so let's talk about financial statement setup. Let's talk about chart of accounts, and I'm gonna also talk about cost codes and the difference. Chart of accounts and cost codes and the difference. So every financial statement, okay, should be set up using what's called a chart of accounts that has a number associated with it. Now, a lot of my clients, I noticed their CPA never associated any numbers with their chart of accounts. So for instance, if you look at your financial statement, how many of y'all have QuickBooks? How many of you all use QuickBooks? If you use QuickBooks, drop a 1 in the chat. Okay, so when you look at your either one, your balance sheet or your profit and loss, how are the categories divided? Are they just names, or do they have numbers in front of them? Just names, exactly. I knew it. Okay. Now, that's okay when you first start, when you're small, all right? But as you grow, you want to start actually getting a number associated in front of that name. Okay, it's not like imperative, but you'll find out as you start doing more sophisticated accounting, you want to start getting what's called your actual chart of account numbering system. Okay, so you can see on this slide, this is normally how it's numbered. You can kind of see on the right, there's an example. Usually your cash accounts would start with like 1,000 or 1,001, 1,002. So let's say you had multiple cash accounts. You may have a 1,000, 1,001, 1,002, etc. And so that will be designated as an asset. Right now, if you don't have numbers, which most of you all said just names, your 1,000 is probably going to be whatever bank you have where you deposit your cash. It's going to have your bank name. So if you have multiple bank accounts, it's just going to have multiple line items with those bank accounts. All right. But when you start seeing like large construction companies, they all going to have a number in front of that name. Okay. So codes 1,000 to 1,900 is normally assets. 2,000 to 2,900 is liabilities. 3,000 to 3,900 is equity. So on, as you see on the screen. So when we start talking about our expenses, they normally start with the 5,000 code, right? So we have our COGS. Now, mine's is a little different. So you can see on this chart of accounts line, the blue line that says 4,020, 4020. It says cost of goods sold. It starts with 4,000. I don't like that. I prefer to drop it into a 5,000 code because everybody knows that normally 5,000 codes are where expenses start. Usually your 4,000 codes are for revenues. Okay. So for instance, I'll have my COGS at 5,000, and this is how I like to separate it. And you all may want to write this down because I didn't put it in the slide. I usually have 5,001 for all my materials for my COGS. So I'll say COGS material, 5,001. Okay, 5,002 is usually my COGS labor. What is that? That's usually like my superintendents, my project managers, anybody associated with that specific project. Then I have my equipment, that's usually 5,003, and then 5,004 is any of my subcontractors. So if I sub out any work, I use subcontractor COGS and 5,004. That's normally how I do it. And then from there, all my other overhead has other line items. Okay. I'm trying to see if I have an example of that or not. Nope.
Could you, hey Mike, could you go over that one more time? You said 5,001 is your
usually 5,001 I do materials, 5,002 labor. So let's say I'm on a job or anybody else I have working that job, any labor, you know, that's specific to that job, it's a 5,002. And then 5,003 is usually any of my equipment. 5,004 is usually my subcontractors. So let's say for those that don't have numbers, you just have names. So what you want to do is make sure either yourself or your accountant, well, let me say this. Your accountant should not be the only person that has access to your bookkeeping file. You should have access to it as well, so you can go in and out of it. All right. So when it comes to your COGS, you want to make sure any costs associated with projects, they're not just hidden general expenses, because a bank will look at it and they're like, this not right, because they know all construction companies have their financial set up a certain way. Okay, so all your costs for specific projects should be under COGS. Okay, so of course, should we start implementing the coding now to be? Oh, absolutely. So like those in the mentorship, like if you're in Elevate, VIP, or Elite, like Corey, like set up your call with me. I'll help you set it up. We can do that during one of your one-on-ones, and I'll help you set it up. Okay. Those that in the mentorship, regardless of the level, I have examples of codes in the portal. It's already uploaded. Okay, so you can go download that so you can see kind of exactly what I use. All right. So great question. Great question. Yes. The earlier you start this, the better. Like I said, when I hired our bookkeeper, office manager, she set this up right at the beginning. So we were already set up and so when our CPA came, they were able to recognize. And here's another reason why you should use numbers, because universally certain numbers are recognized for certain things. And so that helps CPAs to identify and categorize costs correctly. So, if you're not coding it correctly, that's what's really happening for most of you all, you may not think it's impacting you yet until you try to go take your financials to a bank or to any lending institution. And they're going to start analyzing your financials, and you have things coded the wrong way. And what's going to happen, they're going to start running percentages on things. And you're going to have numbers in the wrong line item, and it's going to throw things off. And so you want to make sure you're doing it correctly. All right. Let me see what else I'm going to talk about, because I think that's it. Because I really want to get into Glenn's issue. I'm going to show you some typical positions you would normally see in a construction company. Normally, everybody, once you get to a certain point and you can afford an in-house bookkeeper, that's the first person you want to hire. Now, sometimes you're able to combine this position with like an office manager. So you have somebody that's like answering the phones, doing some of your day-to-day administrative work, but they also tracking like all your books. So once you have so many projects where you can't keep up with this and run the jobs and estimate, you want to look at bringing in a bookkeeper / office manager. Now, at one point in our company, we had every one of these positions going on at the same time. So once you get that big, you'll kind of split up like responsibilities. For myself, I always remained as the CFO, and then I brought somebody that was like our comptroller. And then I had an accounting manager / accountant, and then we had other people that was doing like data entry, meaning an AP coordinator, somebody that was entering all of our invoices, because we were getting at one point in time like 100 to 200 invoices every month. And so we had to have somebody enter all that information, open the mail, do all that stuff, stamp it, scan it in, And so those are typical positions that you will see within the construction company, all right? If you need any assistance with that, we do have other things that's available. But listen, y'all, I'm going to do a deeper dive in a lot of this and review this again in a half-day summit, in-person summit. So that'll be one of the events we'll do going into 2025. So if you're interested in that, please let me know. Please let me know. Okay, Marlon says, at what point should you consider hiring a bookkeeper? A bookkeeper? I would say when your external bookkeeper is no longer able to provide you the information timely. Boy, that was a good answer. That was a good answer. Yeah, because what'll happen is you'll have so much in and outs, and when you're not able to recognize what's happening with your financials, you can't make good decisions, right? You can't decide whether you should invest in a different software. You can't decide if you should hire somebody. Why? Because you don't know what's going in and what's going out. You spent money, you haven't even recognized it yet because it's not in your books. Or you have money that you haven't billed yet, you didn't even realize it yet. Or you've overbilled, meaning you overstated what you really should have, and you really have a lot less than you think. Like, if you don't stay on top of that, it's a case for disaster. And I'm going to tell you, every time I find myself in a bad position in my company is because I wasn't managing my financials. My wife will tell you, like, it's a daily routine. And so if nobody's doing that for you, you got to start thinking about when you start having major money start moving in and out of your company, and anything major, I mean, it's relative. I know that word is relative to everybody, but You have one oops, and you'll understand. Mike was right. you have one oops, and you be like, man, I should have listened to Mike. All right, questions. I'm gonna take some Q&A, then I'm gonna get into this last piece with Glenn. If you all want to stay on the line, feel free to stay on. Questions. You please come on. I'm not tracking the chat, so if you all can come off mute with any questions that you have while I pull up this. All right, Glenn, are you able to talk? Hello, Glenn. My man, Glenn. Are you?
So, hey, Professor.
Go ahead. What's up, Marlon?
So Isabel had a question. She wanted to know, how do you know when you hired the right CPA for your business?
Woo. So I recommend a couple things. Number one, I recommend you find a CPA that is industry specific to what you do. Industry specific to what you do, right? So you all are in travel and logistics, so you need a CPA that has a bunch of clients in travel and logistics. That's number one. All right. Number two, you need a CPA that's advising you. So if you have a CPA that's not like saying, hey, y'all may want to think about doing this. Hey, y'all, have y'all thought about this? I noticed this. I had questions about. If you don't have a CPA that's talking to you, they're the wrong one. Because they're not helping you.
That's good.
And so I will always start with a CPA that first is in my industry. So for construction people, like how I found ours, we actually benefited because at the time our mentor connected us with a bonding agent. So we didn't have bonding in place. We didn't have anything in place yet. And through mentorship, that's why y'all know I advocate for our mentorship program. Through mentorship, you know, they led us to the right people. And so we didn't have a CPA at first that was doing this stuff. But in our third year, we did. So from there on, we did it the right way. So we were very fortunate, you know, to be led to the right CPA, and which was a person that was very personable. Like I said, she taught me. I give her all the credit because I didn't know half of the stuff I'm teaching you all now. I didn't know. I wasn't aware of it. I heard of a debit and credit. I heard of financial statements, but talking about WIP reports, work in progress reports, which I didn't talk about today, talking about over under billings, journal entries, and she would give me a page of journal entries to enter at the end of the year, and I had no idea what that was and why. Like, if your CPA is not doing that, you got the wrong one. Because a lot of CPAs, they're just taking and assuming what you dump or what is automated into QuickBooks is right, and it's not always right. And they're just gonna say, "Oh, okay, this is what it is." You got. They're just looking at it. You have income, you have expenses. At the day, did you make money? Do you owe taxes? Right? Because that's less time they spend on it. They still making their money. So you need someone that really cares, because anytime you go to a financial institution to get lending, they're looking at every number. All right, Glenn. Glenn, I guess I got to talk without you. Okay. He must be working hard. Okay, so Glenn had this question in regards to, he has 1099 staff, okay? And everybody knows the difference between 1099 and W-2, right? 1099 staff, W-2. So let's say, for instance, he was paying his 1099 staff $30 an hour. $30 an hour. He's not paying taxes on that number, but he is paying insurance on that number. Are y'all with me? So if you have work comp, depending on the type of work comp you have, you may be paying taxes, work comp insurance on that 1099 employee, depending on what type of work comp you have. Now, how many of you all use a leasing company for your work comp? I need y'all to come off mute and talk to me now, because this is important. How many of you all use a leasing company for your work comp? Meaning, you use a payroll company to get your work comp certificate. Anybody?
Yeah, I use my payroll company for workers' comp.
Okay, perfect. Thank you, son. All right, so now when you first get started, this is the least expensive way to get work comp insurance. Now, the caveat and the problem is, if you have a 1099 employee, most likely that person is not going to be covered unless they're part of your payroll.
W-2.
Right, so only W-2. So if you have a 1099 person that you hire to come do work for you, they get her on the job, right? Most likely they can file a work comp claim against you. All right, and then you have no coverage. Okay, so that's the danger of that. I have another session in the portal talk about insurance. This is not an insurance class, but I want to talk about this. So it's important that you understand what you have. All right, so let's say, for instance, you got a 1099 person. Most likely you have no work comp coverage on them unless you have a traditional work comp policy that covers all of your staff and even your subcontractors. If you have a traditional work comp policy, it will cover not only your W-2, but also your 1099 and your subcontractors. So by chance, one of your subs does not provide you a work comp policy, right? Your carrier will still cover them, but they're going to charge you for them. Okay, they're going to charge you a little extra for them. Okay, so I want you to first know that. So if you're paying a 1099 employee $30 an hour, right? Though you're paying that $30, you're also most likely still incurring some unseen costs. Maybe let's call it 5%. So really, you're paying out of your pocket $31.50 for that person. So when you start considering, should I bring in a person in-house as an employee, you say, well, I don't necessarily want to pay more out of pocket than I'm already paying them, but I want you to now assess what is the benefit of them being a W-2. Maybe you have, quote unquote, more control, right? Because a true 1099, you cannot tell them what time to come in to work. A true 1099. If you're telling somebody when to come to work, when they can leave, they're really a W-2, and you're actually have them categorized incorrectly. That is Department of Labor. All right, that's labor law. So if you have a certain amount of control over that employee, they're really W-2, even though you're trying to pay them as a 1099. That's a big no-no. Okay, so if they're a true 1099, it's almost like they're a subcontractor. They should be carrying their own insurance.
That's good.
Right?
That's good.
If they're not carrying their own insurance, that means what? I gotta pay for it. Now, I remember, going back and forth with a couple people that were 1099s, and they're like, well, Mike, I want to work for you, but you gotta pay me. I'm like, I don't mind paying you, but you gotta realize I gotta pay more money for you to be 1099. Right? And so we had to go through a process. Matter of fact, when we started our concrete division, we hired about, 6, 7, even 8 different people to come on board to do just concrete work for us. And we had this whole situation. Well, I recognized we had so much risk hiring them as 1099s that we actually put them on our actual payroll, and I offset the cost. So basically, I made sure they still got what they needed, but I had to make sure any increases I incurred, I put that on my client and not necessarily eat it. I didn't want to eat that additional cost. I put it on my client. So I want to show you a quick way that a spreadsheet you can use to actually figure out what your costs really are. Okay, so all my clients, this spreadsheet is in the portal under May 7th. So if you go in the portal, look under group coaching under May 7th, this document is actually there. So let me see if I can blow this up just a little bit more, so you all can see this. Let me know if you can or cannot see this. It may be too small. I gotta figure out how to blow it up again. Oh, there it is. Can you all see that? Let me blow it up just a little bit more. Okay, so I had a spreadsheet like this for every staff person, okay? For every staff person, I had a spreadsheet like this. So at the top, I would place whatever their gross earnings were. And then if they had a bonus at the end of the year that I gave, I would place that in here. Okay, y'all can see this right here. All right. And then, now some of these things you all going to have to go back and look at and make sure it's right. But I would make sure I would look at what I paid in taxes for Social Security and Medicare. So I think at that time it was 6.2%, and it should be on the 114. All right, so whatever that math is, that should be that. So if I say 114 times 0.062, right? So that's 7,000. Then I'll take my Medicare taxes, so on and so on. If I had insurance I paid for them, I'll put that in there, okay? Medicare, dental, life insurance. I added all of this. This is what we call burden. If I had a retirement contribution match, if they selected to do our simple RA and I matched it, I put that number in there. Whatever my work comp rate was for them, you have to get that from your carrier, and it should be in your deck pages. I'll multiply that and put that in there, whatever that is. Now, sick leave. This is the thing. These are the things that 1099 people don't realize, right? Once you come on to my plan, I'm giving you benefits. So let's say I'm giving you 5 days PTO. Well, that costs me, right? So I'm gonna put those 5 days or 10 days PTO in there, whatever that cost is. So, and then we have unemployment, state unemployment, whatever that is. So I add all of that up. So when I add all of that up, that came to $25,000, right? So $25,000 divided by this 114, this is a burden rate of 22%. 22%, right? So this allows me to come into an hourly rate. So I would take, let me do this again. So if I want to get hourly rate, just so you don't, so you know, there's 2,080 hours in an annual year. So I would take the 114 divided by 2080 without burden. So I'll call this unburdened. It's $54.80 an hour with burden. Is this is the 54.8 times 1.2203. So really, this person is making 54.80, but I'm really spending 66.8. Does that make sense? Did I go through that too fast, or you all got it?
No, I got it. I understand.
Okay, so when I'm start talking to a 1099 and he's saying, oh, well, I need to make 70, well, I'm like, okay, I actually would do better if you was employed with me, but I gotta pay him significantly less. So for me to get to his rate, I gotta add $15 on top of that. So let's just say he wanted to make, or she wanted to make 70, then I gotta add this 22% on top of that just to know where I'm really spending. So the question would be, can I get this 85.4 from an owner? Can I still stay competitive at that rate in their employees? Here's the thing. I would at least know I have no risk. I would at least know if I got sued or somebody got hurt, we're covered. There won't be any issues, there won't be any problems, right? Because it's the cost, the risk. I've mitigated the risk, right? If they're 1099, it's still a lot of risk out there. So every day we're gambling, you know, on something happening or not happening. We're praying every day, Lord Jesus, please don't let. I get it. It's like living without health insurance. You're like, Lord Jesus, please don't let me get sick and have to go to the hospital, right? So hopefully, Glenn, that helped. I'm not sure if you're going to have any other questions around that, but I know that you're trying to make that decision, and to me, that's one way I would analyze financially. Does it make sense? Sometimes you got to outweigh, well, what's the risk? You know, because one claim, I've only had one injury claim ever in the history of our company in 20 years, one. And that one person who had previous work comp claims that we didn't know about almost cost me the ability to get insured. One claim. And it was only $80,000 claim because she ended up having to have surgery or something. Like, you just don't know. And the thing is, you don't want to risk putting your business in jeopardy or not being insured just for something like that. So sometimes it may make more sense to get a little bit more control, like over their time, what they're doing, the culture you want them to exhibit, how they're treating your clients and your people, right? You have a little bit more control when you bring them in-house. All right, so that's just my 2 cents. All right, anybody else? We'll take Q&A. We'll take Q&A. I'll take 2 questions, and we're going to wrap up and be done today. And wish you all a Merry Christmas. All right? Rest Door, you have any questions? It's good to see you again. I was thinking about you the other day.
Yeah. I had a meeting with you the other day, but I missed, but you didn't come on or something. I don't know. There was some confusion.
Yeah, it was some confusion. I thought it got canceled.
No.
Okay.
No.
All right. Well, let's schedule it. Let's reschedule it.
Okay. So how do I get into your access to your calendar?
I'll email it to you.
Okay, sure. No worries. Okay, thank you.
All right. All right. Malachi, you have any questions?
No, sir.
All right. Corey?
No questions. I'm all set.
All right. Melissa? Marlon? You or Isabel have anything else?
No, thank you, sir.
All right. Nehemiah?
No, I have no questions. Definitely. I definitely see about that because that actually spoke to a conversation I had today with my business partner as well as another individual, and and I screen recorded that whole scenario that you just gave, so they can kind of hear that and understand. Hey, here's the difference between 1099 and the actual W-2. So I appreciate it.
All right. Good stuff. Good stuff. Actually, this should be on YouTube. So if you all want to check out the YouTube page with the other podcasts, I am going live today. Now, y'all know I don't do every session like this, but it's December, it's the holidays. So I wanted to show some generosity and help as many people out as I could. So this also will be on YouTube in case you want to catch the replay. All the documents will be in the portal for our mentorship members, okay? Thank you for that, Justin. Good to see you. All right, Edward, you have any questions?
No, man. Great teaching today, man. I appreciate it. Thank you.
Awesome. All right, listen again, you all. My wife will put my email in the chat. If you have questions, concerns, challenges, please, like I told Glenn, I said, Glenn, bro, you're an elite mentorship member, client. Like, bro, don't be sitting over there struggling. Text me. And then he texted me yesterday. Yeah, text me, right? You all let me know what's going on so I can help you. Even those of you that are not clients yet, please don't suffer in silence. I'll do what I can to help you. Somebody help me. So whatever I can do to help you all get further. Listen, if you have not figured out your 2025 strategic plan, what are you doing in 2025? I need you all to work on that and get it done before the end of the year. What's your strategy for 2025? What's the clients you're going to meet with? Who you going to go talk to? Right? I need you all to start putting pen to paper on this, okay? So you have an actual plan and strategy. If you have a revenue goal, well, how are you going to complete it? What's the tactics? What's everything you have to do to make sure that number happens, right? We're not playing around guessing at numbers 2025, y'all.
Got to know our percentages.
You got to know your percentages as well. Yep, you got to know the numbers. Numbers don't lie. All right, if you need additional assistance, please feel free to reach out to me. Let me pray over you. Again, lastly, happy holidays to all of you. I know for some this is not the easiest time of year, and for those of you that have family that you will be with and celebrate, I pray that you have a joyous time. But let me pray over you. Father, we just say thank you for this time well spent discussing construction accounting. I pray over every person that's on this call now and those that may be jumped off. I just pray that you bless them in their business. I pray that you help them to continue to grow, to continue to learn and expand. And Lord God, let nothing get in their way. Let nothing stop them or slow them down. And I just pray that you will encourage them, God, that they won't give up, that they won't throw in the towel. But God, that you will make your desire, your plan, your will crystal clear for their lives. And I just ask a special blessing of increase over them. And we just say thank you, God. I ask that you keep them protected on the dangerous highways and all the violence and the chaos that's in this world. Bless their families, their children, their grandchildren, and all those around them, their employees, their staff. I just say thank you, God, that you're going to continue to make provision for them. We say thank you for all these things. In Jesus' name we pray. Amen. All right, family, God bless you all, and we'll see you in the next year, 2025. All right, bye-bye.
Thanks, Michael.
All right, bye-bye.